So welcome to another Hacking Finance podcast with myself, David Galbraith, and Sean Park from Anthemis. This week, we're going to talk about risk, one of Sean's favorite topics, I think. Risk and how it's changing in terms of analyzing complex systems and what that means for insurance, and more broadly, what that means for all sorts of software, including the rise in complexity of everything around us and what we call technical debt, and maybe extended to what we are calling civilizational debt. So I'll hand off to you, Sean, because I know you have a particular thesis about risk.
Yeah, where to start, really? I have a hypothesis. I don't know if it's a thesis because I don't think it's proved, but and I started sort of when this hypothesis emerged in the run-up to and then the wake of the global financial crisis, and inappropriately stealing from physics or chemistry, the law of conservation of risk. And at that time, sort of like the alchemists before then, there was, at that time being before the financial crisis in the late 90s and early 90s in capital markets, there had been, this Cambrian explosion of financial derivatives over the last, over the previous 2 decades, maybe. First interest rate swap, I think, was transacted in 1987, I want to say. That might not be right, but, that order of magnitude. And then by the turn of the century, there's various, clickbaity metaphors being bandied about, but weapons of mass destruction and all the rest of it. But derivatives are, like any technology, they're just technologies, and they can be used for good or for bad, intentionally or unintentionally. But there was this, and I think it was an enormous contributing factor to the financial crisis. There was a increasing amount of hubris, in the sense that these very, very smart people, and they were mostly very, very smart people, mathematically smart or intellectually smart, became overconfident in their ability to, or their perception of their ability to manage risk, or even they went further than saying that they were managing risk. They could eliminate risk through essentially through complex mathematics that instantiated in financial derivatives, very, very complex financial derivatives. And of course, that wasn't the case. The first, my blog has been lost to the history. I think it's on the Wayback Machine somewhere, but at post-financial crisis, I figured out, like, every financial crisis is hubris times leverage equals, disaster at some point. And there's some sort of threshold that once you've attained with that multiplication. And that's where this hypothesis emerged that, risk, what was happening was that risk wasn't being eliminated, but that was the narrative, that, these super clever people in Wall Street and in the City of London and elsewhere were eliminating risk to the great benefit of humanity and their bank balances. But it was just being moved around. But then there's a second part to that, which is just being moved around. So these are sort of the counter narrative, the 99%, in the context of derivatives, not in the context of the big social change, was, derivatives bad, shuffling risk around is like a complete zero utility for civilization, humanity. It's just a bunch of rich people playing games and getting richer. That also, I believe, is false. So moving risk around can have, even if that's all you're doing, can be enormously beneficial. And I think, actually, if you just take it back, you don't need to be some financial guru. Just the idea of syndicating risk is one that's like as old as human civilization. Mutuals, in the feudal agrarian economy, there was mutualization of risk. And even going further back, and I'm not a good enough student of history, but I think the first agrarian societies that emerged out of, Mesopotamia, there was, I think numbers and a lot of language actually emerged to be able to mutualize risk of bad weather, bad crops, starvation, essentially. And so anyhow, that was a bit of a rabbit hole, but to say that this hypothesis that there is conservation of risk is important, because if it's even directionally true, because to get rid of this hubris about, if we're clever enough, whether it's in financial technology or, information or computing technology, that we can eliminate this risk. I think that my hypothesis again is that that's untrue. We can transform it, we can move it around, but there's some sort of conservation of risk. And then if you accept that, then I think you can do really, really interesting things, right? Because then you can, like if you're lucid enough to say there are basically the unknown unknowns, or even the known unknowns, and there's exogenous factors that, cannot be modeled. Unless you have, it's sort of the map in the universe, unless you have a compute that is an exact copy of the universe, but then there's no point, like, even if that was theoretically possible, like you've gotten nowhere, right? So there's always going to be, and this is what I think risk is these unknowable, uncalculable outcomes in terms of, in deterministic sense, but then good mathematics and good technologies can make approximations, and anybody who's been involved in insurance or risk management knows that those can be enormously powerful tools, unless or until you have the hubris to think they're perfect, right? And I'll finish maybe the intro on that is that, like, probably the single biggest contributor to the not the actual financial crisis and how it played out, but the fact that it was so enormous and violent and quick, and almost brought down the Western banking systems, was VAR. And for listeners out there that aren't capital markets geek, VAR is value at risk. It was invented, I believe, in the mid-late 90s by some very smart people at JP Morgan. That was actually eventually the concept was spun out into a company called Risk Metrics. But there's this idea of value at risk, where you could take math and you could take a whole bunch of different things that were very hard to compare, different types of fixed income instruments or equities or commodities or what have you, and you had a framework from which you could get a universal measure of risk across a portfolio. And it was a super smart and super useful and super powerful tool, but it flipped from being like, this is a good model and a good approximation and a good heuristic to help manage risk, to this was some sort of like written in stone tablets, this mathematical ultimate truth. And why that led to the financial crisis is that traders, investment managers, portfolio managers would run their, one of the main heuristics is run your book to VAR 0, right? Or like, I have no risk on, my VAR is 0. And this is where now it's like common currency post-financial crisis. I hope, but I don't believe anyone's sort of gone back to that, but book size matters. So an example of VAR 0 would be with a very simple portfolio, is that you're long $10 billion of Apple stock and you're short $10 billion of Apple total return swaps or option, so you're insensitive to the movement of the Apple share price because you have equal amount of short and longs. The problem is that they're, in that example, and this was repeated over and over, variations of that. One of those is a security, the other one is a derivative. Derivatives have counterparty risk, and so on paper, that statement that you have zero risk is true, but the reality, zero risk in the context of Apple share price moving up or down. But to say that you have zero risk is untrue, right? And the people who wrote VAR, like, so just in case there's any passionate listeners that want to go hunt them down, they knew this. Like, they didn't pretend that this was not the case. Like, they didn't represent this model and this concept as this, again, this perfect talisman for risk management. But traders and then their bosses, and then you got to put this in the context of roaring financial markets in the late 90s and early 90s. Notwithstanding, the dot-com crash was a little bit, that didn't matter. The big financial markets are foreign exchange and interest rates and things like that. And by the early 90s, it just became, well, we have VAR zero. And, people had, like, individual traders at not very big banks. Like, when I say, like, it's not just the people at Goldman Sachs or Deutsche Bank or what have you, or JP Morgan. And it, had trading books that were, billions by billions. But the VAR was zero. So they go home at night, no risk. It's okay. My boss is happy. His boss is happy. The CEO is happy. And then when the financial crisis happened, what happened is that all started to unravel. And, even Lehman Brothers, who, went bankrupt, and, everyone thought, oh, these guys are, they on a VAR basis, they didn't have a lot of risk at the point until it started to all unravel. It was just the VAR was an imperfect measurement, and they had the hubris to not, and they just built an enormous balance sheet, and very small movements in their positions were just amplified by 50 times, 100 times. It doesn't take much. Anyone who's done any sort of speculative betting or trading on some of the the retail sites knows that if you have 50 or 100 times leverage,
yeah,
so there's a blip and you lose all your money, or
so,
you double your money. But
so before we move on, I really wanted to do this particular podcast in three sections, like what is risk, or what are the mathematical ways of dealing with risk, and then what's the overall environment we're seeing for risk, like technical debt and or civilizational debt is the sort of neologism come up with for that. So I thought long and hard about what you were saying about conservation of risk, and obviously coming from a sort of family background of physicists, there was the thing that struck me was the parallels between energy and entropy, in the sense that most people think, oh, we waste energy, and they also think, oh, we need to make things sustainable, therefore we don't need to use energy, missing the point that human beings on Earth, the total sum of all the energy we consume on Earth is zero, which is, people go, well, what? We use lots of energy. No, people don't use any energy because it's conserved. It's very, and secondly, there's an unlimited amount of it because the sun rains down high energy photons and we actually re-radiate into space more photons. And so what's actually happening is there's a very big difference between energy and usable energy.
Yeah.
And there is a very big difference between risk and systemic risk, i.e. things that will, $1,000 might make someone bankrupt, but it's not going to make a large organization bankrupt. So,
yeah.
So exactly what you're saying about VAR is that where this invisible risk, where it's sort of buried, is at what point does it become systemic? At what point does it actually wipe people out or do things that remove people's choices? And so most people can absorb a certain amount of risk. And the thing that fascinates me is that the sort of traditional approach to risk in, let's say, insurance, aside from pooling, is that in theory it's pooled, but actually it goes on to bigger and bigger balance sheets with the assumption that there's this grenade of risk, and that you just need to put it in a big enough box that it doesn't blow it to pieces. And like the reinsurance company is a big enough balance sheet that the grenade goes off and it doesn't wipe it out.
Yeah.
But that doesn't really dissipate it in a meaningful sense. Whereas things like cat bonds and things like that, which chop it into bits, do actually get rid of, in a meaningful way, of that systemic risk, because they actually spread it out a lot more. And so that's sort of where I'd gotten to in terms of I totally buy that risk is a conserved quantity, and that therefore it's very dangerous to try and ignore that. But I think people can look at the systemic versus non-systemic risk and how to package it differently.
I like that. I like framework. And there's some risks that are like uninsurable, right? In that context, especially if you use that mental framing, or uninsurable in a traditional sense of, and the non-traditional sense. What I mean by that is like by setting aside capital to mitigate unforeseen or even modeled expected losses. and this is where we've had lots of discussions about this in the context of the future insurance, where, again, hypothesis, not yet proven, might be wrong, that in the context of those systemic risks, insofar as you might be able to insure them in a generic sense of insurance, not a specific or financial sense, it's about understanding the emergent sources, known and potentially unknown, of those risks, and making structural changes to behavior, culture, technology, society, like civilization, to mitigate those. And that would need to be a never-ending, constant adjustment, right? Because like you said, these are complex adaptive systems, so there's feedback loops. So anything that you did that, even assuming that you could be smart enough to do things that really had an effect in terms of mitigating any sort of systemic risks, they would introduce almost necessarily unintended or different risks. And it reminds me, and I'm gonna stop there because this is like beyond my, but I remember a class in university, I think of fluid dynamics or whatever, and this is date myself, but when these super fighter jets were, next generation of fighter jets were invented, that were unflyable without advanced, well, at that time it was very advanced, now it's probably like way less advanced than your phone, but advanced computation, because they had to make like thousands of adjustments per second in terms of the aerodynamics, because the planes were fundamentally not aerodynamic or not stable, unlike traditional planes, which can glide in without any power for and fly on their own, sort of thing. And I think there's sort of a parallel with that, where there's but it takes a lot of humility then, and it takes it, you need that at sort of a civilizational, societal level. So I don't want to try to be, I hope listener, I'm an optimist, but those kind of decisions, they're not just business decisions, they're societal and political decisions. And they have costs. They have real costs up front. Nobody ever wants to pay. Actually, even just with traditional, normal financial insurance, a lot of people don't want to pay the price. And so you have, for instance, like the state of Florida, has probably one of the most horrendous balance sheets of any sort of nation or state, because they underwrite a whole bunch of hurricane insurance that is uninsurable, right? Or it's not uninsurable, but the price of insuring it would be, I remember reading a paper, it's sort of like 20% of the price of a property in certain locations, because basically when it becomes that frequent, the math becomes really simple. It's like every 4 years, your house gets like totaled.
No, based on what you're saying, exactly that about complex systems. When we talked about systemic risk, we're talking about a risk to the life of a system. And we're assuming that a system itself can have inputs and outputs, and therefore the amount of risk can actually increase in these systems. Yeah. One of the things that's very interesting about this is that the behavior of systems and complex adaptive systems, the only way to compute them, we know from very simple systems like 3 planets, is through algorithms. Whereas a complex mechanism like a watch, which isn't actually a complex system, can be predicted by a single equation. And so we know the only way of calculating the risk to linked systems is through algorithms. And this, to my mind, Stephen Wolfram was one of the first people, I think, to really articulate this. It was a new kind of science, that there was the science and the world of equations, single equations with an input and output, which a lot of actuarial systems are based on, versus the world of taking the output from an equation and feeding it back in algorithmically and repeating that trillions of times. Will still the only way human beings know of calculating the risk to even 3 systems is through brute force algorithmic calculation. And this, to my mind, seems to be a step that human civilization is on, where we have to embrace this, where we have to actually be able to predict the weather and to brute force calculate it. And I suspect that as a contrarian thinking, the sort of the Luddite conservationist movement view of we need to slow down and return back to nature, I don't think we have that choice anymore. And I think we've seen that through having shut down most of the world through the pandemic.
The risk of going into a next episode on free will and human. So I think so. I mean, and again, I'm not people, when I've had this conversation, sometimes people say, oh, that's very dark, Sean. And, we're individuals. We have, and I believe in human spirit and all, but as a system, we don't. It's just like the sun and the planets. I don't know if they have free will. They form, but they formed. So I think there's like an arc of, physics, or I don't know what the right word is, but there's an arc of history that is beyond our control, that we're a part of. And at various levels we can affect and shape, but that's sort of like noise in like we go to Baz noise, no judgment there, but that's sort of noise in terms of the direction of history. I think we have very little control over.
I'm optimistic in the sense that although we know things are sensitive to inputs and we can't predict the exact output, we can see rough patterns. And I'm optimistic that with sufficient algorithmic computing power, we will be able to predict the weather. We won't be able to predict the weather in a pinpoint fashion, but we already can, let's say 3 days out.
Yeah,
but in civilization, we need to do this at scale.
I was reading an article on the fires in Western America a few weeks ago, and it was interesting. They made the contrast with like weather events, and obviously there's interlinked with some of the fire stuff, but like a hurricane, even tornado, the timelines are shorter, but like for most weather, there's like a chance that we have reasonably good predictions and people can get out of the way. Not always, but they were comparing to these wildfires. And actually, I know when it was subsequent to, it wasn't just about that, but the fires in Boulder, south of Boulder in Colorado over the New Year, or just after Christmas. And these fires emerged, like people had 10 minutes to evacuate their homes, and their homes were burnt to the ground. And it was talking about like the context of risk management, how much fire is a much different risk to manage than weather because of these sort of time horizons. It was a longer, more articulate article than what I just said, but yeah.
I think what I'm trying to say is that systemic risk is what's important to mitigate against. That as a society, we have to use algorithms to now measure that systemic risk because we live in a world of complex systems, and that's fundamentally not how insurance works at the moment, at least much of it.
And then we need to react to them. So there's two things and actually the insurance companies are smarter than you give them credit to, and probably in some instances better than capital markets, because capital markets were driven by people like, I can get a bonus at the end of the year, and even if I know it's wrong, I don't care.
Yeah,
I mean, it's being really cynical. And a lot of the math around risk management in general, whether it's derivatives or insurance, whatever, is based on Gaussian or adapted Gaussian probabilities. And to adapt it, because again, I don't want any of our derivatives trader or insurance actuary friends calling and saying, of course we know it's not Gaussian and all. And, they do, but, and maybe this has moved on, and I'm sure there's some people in certain pockets of the world, the bigger reinsurance companies and some of the big hedge funds that have much, much more complex models now. Yeah. But there was a certain sort of moth to the flame where it's really easy to do the math on normal distributions. And when I say normal distributions, I include like a lot of exotic forms of normal distributions, but making those assumptions rather than open-ended distributions, which are unsolvable sort of thing. So like, that's just not fun, right? If it's like, if the area under the surface is not knowable, then you can't model it. And so I don't have a job, right? So I'm not going to accept that. I'm going to say it's sort of like this, and I'm going to make a whole bunch of like jerry-rigged adjustments with super sophisticated math and computers and all the rest of it. But it is sort of like trying to fit a square peg into a round hole. And then the punchline is most of the time that works, right? In sort of human time scales or business time scales, right? It works for a long time until it doesn't. And as I said, on the capital market side, the people doing that, they know one day it won't work, but that might be in 10 years or 20 years. It might be tomorrow too, but like, who cares? Not my problem. Worst case is I get fired, right? And there's like a giant financial crisis. If it does work for 20 years, then I get, I'm enormously successful financially and I look like a genius. But that's no way to run a civilization sort of thing.
Well, so I mean, given that, so there is this concept in computing of technical debt, which is basically software is built on top of other software, and it gets, the tools become more sophisticated, but there's this buried debt. And basically, technical debt means you got to deal with it later. You got to deal with the complexity that you built up. And so, if we look at how one of the ways that we know that, and I think you're right, insurance companies, I'm not saying insurance, I'm not naively saying that insurance companies aren't using algorithmic methods. I'm making a very simplistic distinction between equations and algorithms.
Yeah.
But we know that in the more sophisticated models, they are moving to, let's say, AI models. That's where a lot of the insurtech activity has been, for example. Yeah. But one of the characteristics of AI, or machine learning in particular, is that normally a programmer codifies things, i.e. they understand the algorithms. In a way, machine learning solutions are generic systems where you have inputs and outputs, and the programmer doesn't actually know what happened. They just know it works. And so, to my mind, the biggest tool we have, so we're in a world where we know we're creating lots of complexity. We know, for example, that the lighting system in most modern cars, there's a Italian company that calculates the sort of how much systemic risk there is in systems, normally for military, and they looked at modern cars, electric cars in particular, and realized that although there's massive simplicity in the engine, there's now a point where the software used to control cars is so complicated that there is a systemic risk from just the lighting systems in a car. And so we know that these things are real everywhere. We can see it all around us, that the world is piling on top of it, dealing with things and creating debt. And this one tool we have, which we're seeing emerge, which is machine learning, to my mind, is like when people talked about derivatives as being weapons of, what was it?
Mass destruction. Yeah.
That's the same with machine learning. That they are weapons of mass technical debt. That they are machines which are solving one problem and creating another, and so,
or sometimes creating 10 others.
Yeah. And so we're seeing this with cyber attacks and ransomware around us, and we're seeing that because software has this exponential quality, that we're creating an exponential increase in the complexity of human civilization and its vulnerabilities. And to my mind, that's why cyber insurance is particularly not necessarily the most interesting place, but certainly cyber risk and people dealing with the effects on the real world, like gas pipelines and electricity networks and things like that, from the vulnerabilities that we've created in these systems.
Yeah. No, and it's interesting. If I were to go back 30 years, and if I was 20 years old again, I think one of the places I might be in, I don't know if it'd be clever enough, but I might be interested in trying to have a look, is sort of the intersection of biology and compute, sort of carbon and silicon, because I think, and I say this with a giant disclaimer, I didn't even do biology through high school, but a lot of the problems that biological systems, our own bodies, have solved, have to do with these enormous amounts of, emergent tech risk and technical debt, and how do you how do you live with that? I think that's I don't know, maybe that's just completely bollocks, but
I could have got the wrong person, but of the RSA encryption, which is send encryption, I think it's Edelman, the A in the RSA encryption, created a very simple biological computer where he literally had two vials that he poured to solve, let's say, the traveling salesman problem, because you can use chemicals and you can use, which are by extension biology, to solve very complicated problems in massively parallel fashion, the way that, like you say, human bodies have to, because we've evolved to be part of these systems.
And so building on that, what I'm sort of thinking is we're now reached a level as a civilization. I'm not suggesting it's like all of a sudden a phase transition or something like that, but in terms of like the preeminence, when we were 100 million people on the planet and the way that we lived, I don't know when that would have been, maybe 2,000 years ago or 3,000 years ago. There's, that wasn't really relevant. Today, fast forward today, and we're, I don't know, 8 billion or whatever, and entirely networked and all the rest of it. It's the system, right? We're just, and I always find it fascinating. People love, well, not all people, but a lot of people love studying ants and like, colony animals, right? Colony biological systems. I don't know if that's the right nomenclature. Where the emergent intelligence and systems is much more interesting than the individual. Like an individual ant is not very exciting and not very clever in traditional senses or whatever, but the colony is enormously complex and interesting and does. And I think like where, again, I'm not sure it's a phase transition, but where the preeminence of that, and it's really hard though, and maybe it's hard for ants too. I don't know if they have this sort of self-referential, like, I'm important and I have free will and but we do, we all do. But if you try to, remove yourself from the system and try to observe it with some semblance of objectivity, or not even objectivity, just remove civilization is a much more interesting, like what you're talking about in terms of technology debt or technological debt or civilizational debt is playing out at that level and not at an individual, even group level. And so, and I think, and myself included, like it's one of those things that's really hard to, it's like thinking in dimensions beyond 3, right? Or 4 if you include time, but like it's just hard. It's hard to do, maybe impossible. Or maybe only people like, special gifts like Stephen Hawking or whatever can do that.
I totally agree with it. And one of the sort of biggest mysteries of the universe is phase changes. Like, why is water different from solid? Sometimes it's really not clear why something is fundamentally different on a continuous basis in theory. And so I do think that civilization itself and the way that humans interact will create phase changes in our knowledge and our ability to operate. And as I say, I'm optimistic in that I think the way of dealing with risk is at the core of how we might go through this phase change, of dealing with the fact that we are affecting our global system, our planet. And
but that's super hard, isn't it, politically and societally, right? Because the decisions that might be not marginally, but like enormously sort of obviously better at a societal, civilizational level, might be horrendous for individuals or individual groups or, and I don't know how we, if that's even possible, right? It's so long as we have, sort of self-determination and, I don't know. I just threw that out there as like,
no. I think that's things that we've seen.
Philosophical question.
Well, we've seen that with things like, any form of carbon credits, whatever, is that when you have one system, it's very hard to align the right incentives where everyone actually competes to the benefit of that system. In the prisoner's dilemma model, it's seemingly short-term better to defect rather than preserve the system as a whole. And so the only way around this is to look for models like that. Like, well, what makes people cooperate in the prisoner's dilemma, or what makes what sort of taxation systems allow people to look after the long-term interest of the entire system as a whole. And these are the kind of questions I think that human beings need to deal with. So I think, I mean, in summary for this conversation, on the one hand, it seems like we're going down a massive rabbit hole, and this is really wonkish and really weird. But in a way, this is where finance and being geeky about finance and technology actually does deal with the biggest issues and the most important issues. And I don't think it constitutes a rabbit hole that's not worth going down, because it's one.
Yeah, no, absolutely.
Yeah.
And I think even like some of the things we've been talking about, and even these, which I think are fairly obvious, I also think I have enough humility that they might take a long time to sort of come into place, and probably will look slightly different. But, you know, if you think of sort of tying it maybe back to insurance, you know, insurance today is really a financial ledger that sort of tries to balance the real world level ledger, sort of like my example of Apple shares versus the Apple total return swap, or and it's all measured in sort of finance, and it's about, you know, taking, you know, setting aside an amount of capital up front, investing that safely and wisely, and on a probabilistic basis, basically having the money to mitigate the modeled or the forecast negative outcomes in whatever. And I'm wondering if going forward, and one of the things is that insurance will become a lot more sort of active or real. So just like take supply chain. So if you're, you know, if you have supply chain risk right now, you might have insurance for that, but it's literally, okay, if my factory floods and burns down, or COVID, you know, shuts it down, and, you know, or my supply chain is global, or even low, you know, it gets shut down, an insurance company will cost me $300 million in losses, and I'll get paid by insurance for $300 million in losses. That's sort of how it works today. In the future, it might be, well, actually, instead, and maybe it's the insurance company that mediates this, I don't know, but just from a model point of view, it might be, well, actually, no, I have a dark factory. I have 3 dark factories in different locations, right? And those costs, those are not free, but that's the insurance premium I'm paying. So I won't have those losses. And so instead of putting just money aside, I've actually, and that might, you know, you could say those are 6 of one, half dozen the other, but not really at a complex systems level. They're actually very different, and you know, potentially, again, hypothesis, a much more resilient way of insuring against risk, but much more complex. So, you know, the beauty of the existing the paradigm we're in is it's quite simple, right? And it's well understood, and we have all infrastructure to do it. And, you know, again, I'm oversimplifying, but that alternative is, you know, conceptually maybe not super complex, but in terms of implementation, who pays for it and how it's managed, and actually the excess wasted resources are much more evident, right? And this goes to like human psychology and politics, and like if some money gets paid in premiums and sits on an insurance company's balance sheet or some reinsurance company's balance sheet, I don't want to be too cynical about it, but most people don't even know what that is or don't care, and all the rest of it. If there's a bunch of, just take the example again, if there's a bunch of like dark warehouses or factories, you know, sitting all over the place, and there's probably some environmental consequences of that too, but even like, again, you can see how it gets very complex very quickly. I think even there politically, it's like, okay, why is that factory closed? Why aren't they employing anyone? You know,
I totally, when, I mean, you and I remember when the pandemic hit, we were thinking, well, what are the macro changes? And one of our conclusions was that the shift between efficiency to resilience, and that what that is looking at interconnected systems, and not the health of individual systems, but the health of the ecosystem. And that we've seen, for example, very clearly that the economists were confused. Was this in the pandemic? First of all, it was, well, this is a demand shock because we shut everything down, and that was no, it's a supply shock. And then people are missing the point. It's both. It's a supply chain shock, which has both of those things happening at one time.
At every level, yeah.
And so I think it's a perfect example of how looking at the health of systems as a whole is the only way to analyze this stuff. The demand or supply shock is that sort of very linear equation-based view of the world rather than the systems view.
Yeah.
Yeah.
But then again, in a globalized world, and even if we become less globalized or whatever, I don't see, I don't even know if there's anybody with any sort of credibility sort of saying, we're going back to a world where, tiny localities are, completely removed from any outside system. Then this is where, politics and our sort of socio-economic constructs that we overlay on the real economy become enormously problematic, because the coordination costs are significant, or maybe even unovercomable in the context of building those resilient supply chains, or building resilient systems in general, because they go across borders or across political entities or interests in different groups. But that efficiency to resilient thing, I think it's interesting. It's like coming back to maybe like circling full circle to the top of the discussion, is that's the conservation of risk. So efficiency looks like you're getting rid of risk, which is the the heat energy of like inefficiency, but you're not. You're just storing it up in some unknown place, and it's like that's going to go, it's like a bunch of ammonia sort of storing itself up before, and it's fine for a while, and then there's a spark and boom, the whole thing blows up.
But I think that would be a good place for us to close, because bringing that back to physics, that would be any system with energy creates waste by definition. This is one of the fundamental laws of the universe. And the law of the universe also might be that any interactive systems cannot become supremely efficient. There always is going to be a net accumulation of risk.
Yeah.
And I think understanding that means we can't then brush it under the carpet.
Yeah, and I think understanding is important, not on some sort of ideological, like in principle basis, because it's what allows us then to move forward, right?
Yeah, exactly.
And have the humility to like roll our sleeves up and start hacking at these problems, right?
But the conclusion would be that everything we do increases risk. We just have to make sure it's not systemic risk.
Yeah.
Yeah.
Boom.
Okay, that was great. I know this was, for people listening, that was seemingly wonkish, but I think that was one of the better discussions we've had, because I think it shows some of the things we're thinking about Anthemis, and how something seemingly quite geeky is really, really important, and finance can help. So thank you.
Super. Thanks, David. Good to talk.